Valens Research, Uniform Financial Analytics.
And for the last 2 years, when we track the ideas that we recommend to clients on this list, what we see is on a quarterly basis, after we recommend them, the average company is up 6.4% versus the market up only 3.2%. So these uniform accounting-based ideas are doing double the market. Over a longer time span, when we look at just using a simple uniform accounting scorecard, looking at the companies with the best returns under uniform accounting, the best at growth and investment, and also the lowest valuations, what we see is that the return on an annual basis is 15% a year versus 5% for the market, 3 times the market. So just for context, we know uniform accounting analysis works when we use it the right way. What we're trying to do here with these newsletters is help you as an investor and as a client use uniform accounting the right way. And so for context, right, these are names that we've highlighted like Citrix that we highlighted back in February of 2018. Since we highlighted Citrix, focusing on issues for Citrix like the idea that while the company has gone through a transition, right, and ROA has declined because they actually divested one of their businesses, the GoToMeetings business, actually the business that we're using right now for GoToWebinar, and also they went through a transition from a yearly subscription business to a long-term monthly subscription business, similar to what happened with Adobe. The market is pricing in that ROA that's at historic low levels is going to sustain at these levels. But if we actually look, what we can understand based on the fundamental transition that Citrix has gone through and being able to compare Citrix to companies like Adobe that have already gone through this transition, we know that ROAs are going to get back up to these 30% levels where the market is pricing them as though they're never going to make it up there. And we also see a management team that's confident about their initiative to be able to execute on those factors. Since we highlighted this name in February of 2018, the stock is up from $91 to over $106, $107. It's up over 16%, while the market over the same time period has not been up nearly as much. Similarly, we highlighted Zillow back in January of 2018. Well, the stock has dipped recently. Even since January, the stock is up significantly. Why? Because a lot of the factors that we highlighted that we were only able to see using uniform accounting. Using as reported accounting statements, Zillow looks like it's a negative ROA business. It looks like it's hemorrhaging money. But in reality, using uniform accounting, we see that Zillow is actually a very strong business with ROAs that are approaching 25% plus. Why is that? Because Zillow owns their space. They acquired Trulia, one of their only competitors, and have really turned into the Expedia or the Priceline of home buying and home renting. Because of that, they really own a market that has significant growth opportunities. And we're seeing a management team that when we look, we see confidence from management about areas that they are actually using to grow in terms of working on engagement, controlling cost pressures, and also revenue growth that tell us that while the market is pricing in Zillow to have ROAs that decline significantly going forward, we're seeing ROAs that are likely to move higher. Since we highlighted Zillow, Zillow's been up from $42 to north of $50 and really up over 20+%, driven by the fundamentals that we're seeing here. The last example I'll give you in terms of, if you will, how successful uniform accounting is Planet Fitness from September in 2017 when we highlighted this name. Planet Fitness is interesting because using as reported accounting statements, they look like they have terrible returns, partially because of all of the distortions related to them previously being private equity owned and what that means in terms of all of the weird accounting they have for things like preferred share, tax offsets, et cetera, that are all really not related to the operations of the business and in fact are going to be resolved in the next year. Once we remove all of those distortions, which we do under uniform accounting like all of the other adjustments we make to make it so you can focus on the fundamentals of the business, what we see is a company where the market expects ROAs to basically be flat for the next 5 years. That might not sound interesting. It might sound like a company that's probably fairly valued, but what's interesting is there's a reason this company has ROA that's inflecting higher from 2016 to 2018 in this chart right here. The reason is because Planet Fitness is a franchising business. They are basically investing in their business to be able to, they do not have to invest in their business to grow their business, right? In essence, they let other people pay them to be able to use their brand and use their equipment in their own gyms, what you call Planet Fitness franchising. Because of that, as they grow and they're forecast to double their store count over the next 5 years, they are not going to see nearly as much invested capital growth as they're going to see earnings growth. So ROA is likely to potentially even double over the next 5 years while the market's pricing in flat ROA. Because we were able to identify this before other investors, because we were using uniform accounting to see through the accounting noise, we were able to identify this name. Since then, the name has been up from $27 to north of $40, up well in excess of 50%.
Valens Research, the world's leading source for uniform financial analytics.